For centuries, gold has represented the ultimate form of trust. Kings, empires, and nations rose and fell. But gold remained the final settlement, the last reserve, the asset with no counterparty risk. Or so we were told. Today, the global financial system claims to hold more gold than ever before. But a deeper look reveals a disturbing possibility. Much of that gold may not actually exist where it is said to be. Officially, central banks report tens of thousands of tons of gold stored safely in vaults. These figures appear in balance sheets, annual reports, and international statistics. Investors assume this gold is physical bars stacked behind steel doors. But modern accounting does not always distinguish between gold that is owned and gold that is merely promised. This is where the concept of gold leasing enters the picture. Gold leasing allows a central bank to lend its gold to a commercial bank for a small interest rate, often less than 1%. On paper, the gold remains an asset of the central bank. In reality, it leaves the vault. Once leased, the bullion bank does not store the gold. It sells it into the market. The buyer believes they now own physical gold. Meanwhile, the central bank continues to report the same gold as part of its official reserves. Instantly, a single gold bar has two owners, one real, one accounting-based. This process does not stop there. The buyer's gold can be rehypothecated, used again as collateral, leased again, or sold again. Each transaction creates another claim on the same physical metal. Over time, the system quietly builds layers of ownership, all backed by the same original bar. In markets like London's LBMA and New York's COMEX, gold is traded primarily in paper form futures, forwards, swaps, and unallocated accounts. For every ounce of physical gold available for delivery, there may be dozens or even hundreds of paper claims outstanding. Supporters of the system argue that not everyone will demand delivery at once, and they are right until they are not. The entire structure depends on confidence. As long as trust remains intact, paper gold trades smoothly. But if confidence breaks, the illusion collapses instantly. Why was this system created? The answer lies in price control. Large-scale gold leasing increases supply without mining a single new ounce. More supply suppresses prices. A lower gold price strengthens confidence in paper currencies, especially the US dollar, by making gold appear less attractive as an alternative store of value. This mechanism became especially important after 1971, when the dollar was detached from gold entirely. With no physical backing, maintaining faith in fiat currencies became a priority. Gold leasing offered a subtle solution. Keep gold visible, available and cheap, without ever delivering it. Cracks in the system began to appear after the 2008 financial crisis. Suddenly, investors wanted physical metal, not promises. Central banks noticed something alarming. Vault withdrawals increased, delivery times lengthened, and some institutions began offering cash settlements instead of gold. Germany provided one of the clearest warning signs. In 2013, it requested the repatriation of its gold from foreign vaults. What should have been a routine transfer took years. Officials cited logistics. Skeptics asked a different question. Was the gold even there? Similar patterns emerged elsewhere. Venezuela, the Netherlands, Austria all moved to bring gold home, quietly, carefully, without accusations. The message was subtle but clear. Trust the system publicly, but secure the metal privately. At the same time, paper gold markets continued expanding. Contracts multiplied, volume surged, and yet physical inventories barely changed. The ratio between paper claims and real metal grew wider, turning gold into one of the most leveraged assets in the financial world. If a major shock were to a currency collapse, geopolitical conflict, or systemic bank failure, investors would rush to claim physical gold. The system would face an impossible task: deliver metal that exists mostly on paper. In such a scenario, exchanges could declare force majeure, contracts could be settled in cash, prices could spike violently, and the long-standing belief that gold is always there would vanish overnight, replaced by a far more dangerous realization: the system was never designed for delivery. Central banks understand this risk. That is why, in recent years, many have become net buyers of physical gold, not sellers. Leasing activity has slowed. Official language has changed. Gold is no longer dismissed as a barbarous relic. It is once again described as a strategic reserve. But the legacy of decades of leasing remains. No one knows exactly how many claims exist on the same bars. No transparent audit has ever reconciled physical holdings with paper obligations across the global system. The numbers are fragmented, confidential, and politically sensitive. This brings us to the uncomfortable truth. Modern gold markets are built less on metal and more on belief. Belief that contracts will be honored. Belief that vaults are full. Belief that delivery will never be demanded by everyone at once. History tells us what happens when belief breaks. Financial systems do not fail gradually, they fail suddenly. And when trust disappears, only physical settlement remains. In such moments, gold stops being a commodity and becomes what it always was, final money. The gold leasing illusion has worked for decades because it was never challenged directly. But as global debt rises, currencies weaken, and geopolitical fractures deepen, the question grows louder. How much of the world's gold? And how much exists only on screens? If the answer is ever revealed, it will not come quietly. Markets will not adjust politely. The repricing will be brutal, fast, and irreversible. And those holding paper promises may discover they never owned gold at all. The illusion was never meant to last forever. It was meant to buy time. And time, in global finance, always runs out. Gold does not default. Gold does not print. Gold does not promise. It either exists or it doesn't. And one day, the world may be forced to count.